Hello and welcome to Trusts and Estates Weekly. I'm your host, Kevin Bemmel, and we are here every Monday at 10 a.m. Pacific time. That's 1 p.m. on the East Coast. And you're probably looking at me and saying, what's wrong with this guy? He had his eyes covered before and now he's got a split lip. Yes, I lost a fight with a wooden post yesterday. I was taking down something called a sukkah, which is kind of like a gazebo. And one of the posts, I lost control of it, and it smacked me in the face. So, yes, it was not a bar fight. Although I thought about making up a story about that, would have been much much funnier at least, and at least I could claim that it was someone actively trying to hit me instead of my own stupidity. Oh well. So stay tuned for next month. Who knows, what injury I will sustain then. Um, so today I'm going to talk about how you can protect your assets, both before, or I should say, while you're in the estate planning process and on through the estate administration process. So I've talked about a couple of these before. And so on some of them, I'm not going to go into a great deal of depth because you can go to our YouTube channel and see other shows that do discuss them in depth. But others I will talk about more thoroughly, so we can all, understand all of these. There's a total of 10 of them. Okay, so let's just jump right in because there's a lot to cover. So first of all, one of the best ways you can protect your assets is by creating a trust and putting your assets in the trust. Now, the thing about a trust is they basically can be either revocable or irrevocable. And I've talked about trusts at length previously, but I just want to hit this point because it is particularly relevant to the issue of asset protection. So generally speaking, a revocable trust does not protect your assets because they're just you, okay? Whereas a non-revocable or an irrevocable trust, that becomes in essence a separate entity from you. And so if you're, for example, let's say you got into an automobile accident, okay, so whatever assets you own as an individual may be at risk, but the assets in the trust may very well not be at risk because you do not own or control those. They're held for your benefit, but they're not owned by you. So that's the advantage from a liability protection standpoint of having a trust. Okay, okay. And by the way, it's not just liability when we're talking about protecting yourself, protecting your assets. We're not talking just about legal liability for, say, a car accident, but we're talking about potentially protecting you from creditors and even from tax collection. Okay, so the rules are not the same for all three of these. Okay, so when it comes down to how they may actually benefit you, this is something you're going to want to discuss with your attorney. But what I'm doing is giving you some thoughts about things you can discuss with your lawyer if you're concerned about this issue, and we all should be, especially if you're here in California. So just as an aside, I was talking with a client last week who does not live here in California but owns property here, and the client was telling me that her insurance broker was surprised that we are recommending $1 million insurance policy, and I said, here in California, that's nothing. I mean, frankly, it didn't seem to me to be a whole lot in the state where this person was living. But in any event, here in California, that's not a high liability limit at all. That's pretty standard. So especially if you have any kind of assets at all. All right. So, and we'll talk about insurance in a few minutes. Next is you can use legal entities in order to protect yourself. So, for example, if you have a business, right, that business can be operated in the form of a corporation, be it a C Corp or an S Corp. It could be operated in the form of an LLC. Both of those give you protection so that if the business is sued, that business is a separate entity from you, okay? And so only its assets are at risk. Yours are not. That's the benefit of having a corporation or an LLC. Now, and again, the same is true of creditors and also potentially taxes. Now, if you have a business and you're a sole proprietor, where you're essentially operating as what's known as a DBA, doing business as. So I could be, Kevin Bemmel doing business as Bemmel Plumbing Company. Well, the company is just me. So if I'm doing some plumbing work in somebody's home and I damage, let's say I damage their, the cabinet or something, right? So not only is the business liable for that, but all my personal assets would be on the line as well, because there is no distinction legally between me and my business. Whereas if I were Bemmel Plumbing Incorporated, okay, now Bemmel Plumbing Incorporated is a separate entity, and that protects me personally from liability, creditors, etc., that are related to the corporation. Now, I'm going to skip to one that's sort of lower on my list because it's relevant here. Now, when you have a trust or when you have a separate legal entity for owning something, by the way, if you buy a piece of real estate, investment real estate, typically it's a good idea to consider putting it in its own legal entity. That way, anything that happens with that investment is within that investment's legal entity. It doesn't affect you personally, and vice versa. Okay. So the key thing then in all of these is to pay attention to what are called title vestings. Okay. So let's say you create a trust, even an irrevocable trust. Okay. But all your assets remain in your name. That trust is not going to afford you any protection. Let's say you create a corporation for your business, but you constantly move funds back and forth and you treat the business like your personal, your personal account, and your personal account like your business account, and don't keep separate records and all those kind of things. You may very well have created a situation where the protection that corporation gives you is diminished. So you want to make sure that assets owned by an entity are in the name of that entity. So let's say that you buy a property at 123 Main Street, okay? And you decide, well, I'm going to create an LLC to own that property. And you name the LLC 1234 Main Street LLC, okay? When you buy that property, it needs to be titled in the name of the LLC, not you personally. And indeed, it would be best if you never took title to that property personally, but the LLC was in fact the buyer of that property. That makes it clear from the get-go that property was owned by a separate entity, okay? And for sure, it needs to be titled in the name of that entity, okay? If your business buys some property, let's say you have a vehicle that your business uses. I'm going to keep the example of the plumbing company. Let's say you have a van that you use for bringing your equipment around. That van should be in the name of your corporation. Okay, so let's say you call your plumbing company Plumbing Company Inc., right? So when you buy a car, Plumbing Company Inc. should be the buyer of that car. And your company, Plumbing Company Inc., should insure that car on behalf of the company. Okay. You shouldn't rely on your personal insurance to insure you for driving that car around. So you want to make sure all of your assets are properly titled in order to make sure that you get the protection that may be offered by a trust, by a corporation, by an LLC. Okay, now I'm going to go back to the second one, using legal entities, and talk about another way that you can use them to protect you. So let's say you're not really the owner of the entity, but you're an investor in the entity. Okay, and let's say it's you want to invest in a piece of real estate. So a common way of doing that is through something called a limited partnership. Now, in a limited partnership, the people who run and control the investment are called general partners, but they can have limited partners who provide the funds necessary to acquire and perhaps even renovate, and initially pay for the operation of the property. The general partners have unlimited liability with respect to the operation of that partnership. But limited partners' liability is limited solely to their investment. So if you invest $20,000 in a limited partnership, and that partnership maybe racks up a lot of debts, and the creditors, are looking to collect those debts, the most they can get from you is your $10,000 investment in that limited partnership. Okay, but they can't come after your other assets that are in your own name, because you are a limited partner, meaning your liability is limited. Okay, that's the benefit of investing as a limited partner, is you can only be held responsible for the amount of money you put into the partnership. Now, there can be some exceptions to that. So, for example, if as a limited partner, you get yourself involved in the day-to-day running of that partnership, that may create a situation where your liability is no longer limited, because now you're involved in the operations. And so it makes you look like a general partner. And so someone dealing with that property or that partnership might think, well, it must be a general partner. It calls me every day about all these, details of running it. Okay. So again, these things have some complexity to them. I'm giving you just some basic information now to consider. Okay. But in all of these cases, unless you are a knowledgeable, skilled investor, you really encourage you to learn more about them, get expert advice. Okay, so next, insurance. So insurance is typically what we think of as the way we protect our assets. And indeed, that is the purpose of insurance. It's to protect ourselves financially from things that happen. So generally speaking, in this case, we're talking about property and casualty insurance, although life insurance can also be used to protect your assets in a different way. But I've talked about different types of insurance on my shows before, so I'm not going to get into a lot of it here. But suffice, I'm going to talk about the two basic categories of insurance. There's property and casualty, and then there's kind of life, health, and disability. So property and casualty is protecting you against liability. So, for example, automobile insurance is a type of property and casualty insurance. It protects you if you get in an automobile accident. It protects you if your car gets damaged, those kinds of things. Same with homeowners insurance or renters insurance. They protect you against damage. So instead of having to pay to repair the damage, or pay, let's say you caused the accident, God forbid, and you get successfully sued, if you have automobile insurance, generally that insurance will pay for the damages in that lawsuit as opposed to it coming out of your own pocket. So that's generally speaking how property and casualty insurance works. Now, sometimes, especially if you have a very high net worth, your basic automobile policy may not have high enough limits to protect you. So in that case, you may get something called an umbrella policy. And that umbrella policy sits above your other policies, your car insurance policy, your homeowner's policy, whatever, and it provides you additional liability protection. Oftentimes, these umbrella policies are not particularly expensive relative to the coverage, and that's because they're kind of almost a secondary type of coverage for you. Okay, but it's, again, if let's say you've got a net worth of a few $1,000,000, so your automobile insurance policy probably does not come even close to protecting your net worth. Okay, so even a high limits on an automobile insurance policy may only be $250,000, $500,000. So that's just a fraction of your net worth. So in that case, you would be well advised to consider getting an umbrella to protect you over and above the limits of your automobile policy. Now, life, health, and disability doesn't protect you so much against what are called casualties, like being sued or having your property damaged. They protect you from unforeseen circumstances. So life insurance protects really your family, your heirs, from your untimely death. Okay, it can also be used if you have a large estate that's subject to estate taxes. There's a way to use life insurance to potentially pay some or all of the estate taxes that you might be liable for when you pass away. Okay, and by the way, if you have your property in a trust or in several trusts, that alone does not necessarily protect you, or should say prevent you from being liable for estate taxes. Okay, so these become complex situations, and so life insurance can be a way of helping with that. Now, health insurance, obviously, that protects you if you get sick, and disability insurance, again, if you get disabled, it protects your assets because it provides money for you to be able to live without having to use whatever assets you have to do that. Okay, same as long-term care insurance, right? There's many different types of insurance within this larger realm. All of those are designed to help cover things like your cost to live without defraying the value of your assets. So insurance is a very important tool. Okay, next is something called a homestead exemption. Now, I don't know if all 50 states have this, but I know here in California, we have a homestead exemption. And you know what? I should have looked what the amount is. I'm going to look it up here really, really quickly. Okay, yeah. So the homestead exemption varies by which county you live in here in California, but it runs from roughly $350,000 to $700,000. Okay, and how can this help you? Well, let's say that you have a house and that house is worth $600,000. Okay, and you live in a county where the homestead exemption is $350,000. And let's say that you have a $200,000 loan balance. I'm sorry, let's say you have a $300,000 loan balance still outstanding on your house. Okay, so the house is worth $600,000. You have a loan balance of $300,000, which means you have essentially $300,000 of equity in the house. Okay. Now, the $350,000 homestead exemption covers more than your equity in the house. So not only would it protect your equity, meaning your house, you're not going to be forced to sell your house to pay the $300,000. It will most likely prevent having your house sold at all because if the creditor were to sell your house, they're going to get zero anyway. Okay, now let's try a slightly different example where your loan balance is $200,000. That's why I changed the amount a minute ago. So you've got a house worth $600,000. You have a loan balance of $200,000, meaning your equity is $400,000. Now, in this case, with a homeowner's exemption of $350,000, do you see that only protects $350 of the $400,000 in equity? Okay, so it may not prevent the sale of your home for the creditor to try and get that additional $50,000. It'll depend on costs of sale and those kinds of things. Okay, but now you're not on as firm ground. Okay, so the homeowner's exemption, it can prevent your home from being sold at all, but at least it will protect your equity to the amount of the homestead exemption. Okay, now there are likely other states that have this. I would encourage you to look into this in the state in which you live to see what kind of protection, if any, it may afford you. Okay, and in some cases, it almost incentivizes you, not to pay your loan off, because paying your loan off could mean that you have equity over and above the homestead exemption, and therefore it makes your home potentially liable to sale if someone is trying to collect that equity. Nonetheless, I'm not saying, by the way, that you should borrow money simply to take advantage of the protection that the homestead exemption gives you. I'm only pointing out that these two things can work in concert, and there's something to think about as you consider your overall financial situation. So you may decide that overall you have more peace of mind owning your house free and clear. That's a perfectly valid decision. On the other hand, maybe you've been thinking, well, if I double down on my mortgage payments, I'll pay off my loan more quickly. But in light of the fact that having a higher loan balance protects me potentially from my home being sold adversely, so maybe I won't pay it down as quickly. Maybe you have a very low interest rate anyway, and so again, these are all things to talk to your financial advisors about, your attorney about, assuming that your state has a homestead exemption. Okay, so we've covered 1, 2, 3, 4, 5. Okay, next is retirement accounts. So oftentimes, well, not oftentimes, but sometimes, if you have assets in an IRA or a 401k, they may be shielded from creditors. Okay, it depends on the circumstances. Now, these can be very complex issues. I'm not going to get into them too deeply, but if you have retirement accounts and you're concerned about this issue, this is something to talk to your advisors about to see what, if any, asset protection you have in them, and how you may be able to increase that asset protection if possible. Okay. But savings in retirement accounts, as opposed to a savings account in your own name, may afford you some asset protection that, again, having the account in your own name does not. All right, pre and post nuptial agreements. So these protect your assets in the event of the breakup of a marriage. Okay, and I had a guest, Lori Israel, on. I think this is probably about a year ago now, one of the top experts in prenuptial agreements. And I encourage you to take a look at that show if you're interested in prenuptial and postnuptial agreements, because I think that Lori has a very balanced approach to these. Because when you think about it, if you're going to get, let's say, typically they come up where spouses, either there's a big imbalance between net worth, where one spouse has a very high net worth and the other doesn't, or where both of them have very high net worths. and they're concerned that, somehow if they get divorced, the other spouse will get a hold of their money. So Lori has a very sensible approach to this, because on the one hand, it can be very off-putting to the spouse who's being asked to sign a prenup, right? Of what you think, I'm only marrying you for your money. Or, it can be very difficult for the person who thinks they may need the protection of a prenuptial agreement, i.e., I don't want this person that I love to think that I think they're after me for my money or anything like that. And yet at the same time, it may be necessary, especially if it's a second marriage where you want your assets to go to children from your first marriage, and maybe there are other children involved, that the person you're marrying has children as well, and your children may not think it's fair for the other children to get it, because after all, it was from their parents that the money was, or whatever. These can all become very difficult family issues. They're, first of all, they're best dealt with up front, not with wishing and hoping. And second of all, a prenuptial agreement may be an effective way to provide some protection. And as Lori points out, it's not just because you have a prenuptial agreement at the beginning doesn't mean it has to continue forever after in your marriage. It may sunset after a number of years or something like that, or the terms may change over a certain term of years, where if the marriage proves to be enduring, then the spouse would end up getting more than if the marriage ends after, say, 3 months or 6 months or something like that. So this is an area where you absolutely want expert advice. It is by no means a simple area. And so if so someone like Lori Israel, I highly recommend. In fact, I will put Lori's contact information in the show notes, just because I brought up this issue of prenuptial agreements. Now, next is regular estate plan reviews. So I was just having this discussion with a client last week, I believe it was, maybe the week before. I'm helping them put together an estate plan, and one of the questions they asked their lawyer was, well, how often should we have this reviewed? And again, this is an issue I've talked about before, but just real quickly, in general, anytime you've had some kind of significant change in your situation, you are well advised to have your estate plan reviewed. And in any event, maybe every 5 years or something like that, it's a good idea, if nothing else, just to have a cursory review done of it. And even if it's just something that takes your lawyer an hour or so to do, and confirm, no, there's no changes, nothing needs to be done here. That hour of your lawyer's time is probably money very well spent. Okay. But in any event, it is something, and minimally, if something changes in your life, or you think there may have something may have happened in your life that could warrant a review of your estate plan, so pick up the phone or send your attorney an email and say, hey, here's what's going on. Should we review my estate plan? Okay. And ask the question. Better to ask the question and be told no. Okay. So, no cost, no foul, no nothing, right? Than to not have asked the question and then regret because you should have had it reviewed, and now your estate plan is not as effective as it might have been. Okay, next, this is number 9, is commingling assets. So I alluded to this a little bit earlier in the show. If you have a separate business entity from yourself, you do not want to be commingling assets, okay? Because that can cause a situation where separate entities, the fact that they're separate entities no longer really matters, or it can allow someone to be able to puncture the separate entity, okay? So have separate sets of records, separate bank accounts, separate checking accounts, separate savings accounts, whatever are necessary for them. This also a little bit ties into proper titling of assets. Okay, these two kind of work hand in glove a little bit. But if you have a business with a separate entity, a corporation or an LLC, it needs to have its own set of records, its own tax returns, all that kind of stuff in order to maintain its existence as a separate entity. And the same is true of your personal finances then. You shouldn't be crossing over. So let's say that you make an out-of-pocket expense for your business. Okay, so in other words, you use your personal credit card. I don't know. Let's say you happen to be at an office supply store, helping your child get school supplies. Here's a good example, right? School's going to be starting up in a few weeks to a month or so. All right, and you're in an office supply store with your child buying school supplies, or your children buying school supplies, and you realize, oh shoot, you know what? I need copy paper for the office. Okay, so while you're there, you pick up a case of copy paper, and think, oh, no big deal, right? Well, it's perfectly fine for the business to reimburse you for that, but you should write up an invoice showing the expense that you bore personally, and have the corporation, if it's a corporation or an LLC, issue a reimbursement payment to you for that cost, and then provide evidence of that expense. Now, that is not commingling funds, okay? And in fact, paying for the paper personally but not being reimbursed, that would be more like commingling funds, because you're using your personal assets to support the business. Okay, so if you buy something for the business, again using your personal money, then make sure you reimburse yourself, but make sure you have something in writing showing that, so it's not just sort of money passing back and forth between your business and your personal checking accounts. That's not a good thing either. Okay, so make sure everything is properly documented. Okay, so avoid commingling, not only accounts, but also debts. So if your company borrows money, then make sure it borrows money in its name, not in your name personally. Now, as a new business, you may be required to make a personal guarantee for that debt. But again, the debt is in the business's name, not in yours. That personal guarantee does not constitute commingling. It only means that, at least for a portion of the debt, whatever the extent of the guarantee is, you are pledging your personal assets to pay it off. Okay, so, but that doesn't necessarily create a situation where the business entity can be pierced. Okay, again, these can be somewhat complex, so you're going to want to get proper advice specific to your situation on them from your accountant, from your lawyer. And that's the final of the 10 tips, is getting proper legal advice. So I've mentioned throughout this show, I think on almost all of these, that if they are something that you might want to take advantage of, this is something to discuss with your lawyer. Now, there are different kinds of lawyers, right? You may have an estate planning lawyer, but that lawyer may not specialize in corporate law, which is, business law. So you may need to have a lawyer who handles legal matters for your business. And then you may have, in essence, a personal attorney who helps you with matters related to other things in your personal life besides just your estate planning. Okay, so the key thing is to make sure that the lawyer from whom you're getting a legal advice is qualified to give you that advice. Okay, they have the knowledge and the experience to be able to properly advise you. And so that may mean that you have more than one lawyer that you're dealing with. Now, I'm in California. Lawyers can be expensive, especially here. It's amazing how much more expensive lawyers are here than they are in other states. Nonetheless, an hour of a lawyer's time can be the most well-spent asset protection that you could ever hope to get. okay? Because that lawyer may identify something you can do with one of these other 9 tips, whether it's a trust, a legal entity, insurance, homestead exemptions, pre or post nuptial agreements, all these other things. They may be able to suggest something to you that can be done very inexpensively that will give you a tremendous amount of asset protection. Okay, so do seek out that advice. Okay, and when you have concerns, pick up the phone, send an email. I know most of the lawyers I deal with, if not all of them, when I send them an email, they're not charging me for every single email they respond to. Generally speaking, when I have an ongoing relationship with a lawyer, they are only charging me if they're actually doing some kind of significant work for me. Okay, or for a client where I'm essentially engaging the attorney on behalf of the client. And in fact, lawyers do this because they realize that they just can't nickel and dime clients on these matters. Okay, so they want to establish a long-term solid relationship, and so that's why they will help you out. Okay, and it's a valid question to ask a lawyer that you're considering. So what if I have kind of a one-off question? Are you going to charge me for answering that question? I think you're going to find most lawyers say, no, I'm not going to charge you for that. Now, if it takes some very substantial legal research in order to answer the question, so I'll let you know, and we'll work something appropriate out to make sure that you get your question answered, and my staff time is covered, or my time is covered for doing this. But I'd say 90+% of the time the answer is going to be no. For a one-off question, I want you to ask me those questions to make sure that I can serve you as well as possible. So, and I can't do that unless I know what's going on with you. So I want to encourage you to ask me those questions, and then when something significant does come up, so then we'll talk about an engagement, and then at that point there will be an expense. Okay, so those are the 10 tips that I have. I'm going to go through them one last time here real quickly, so you got them all. I'll list them in the show notes so that you have them there as well. But establish a trust, use legal entities, homestead exemption, insurance, retirement accounts, pre and post nuptial agreements, regular estate plan reviews, avoid commingling your assets and properly title your assets, and finally get good legal advice. Okay, so that's our show for today. Tomorrow at 10 a.m. Pacific time is my show, People Making Money. And I'm going to be talking about when should we advance and when should we retreat in our businesses. And I'm going to be using the example of Marshal Ferdinand Foch as sort of a case study from a military standpoint as to when what we should consider when making that decision. And then on Wednesday at 10 a.m. Pacific time, on my show, People Making Money, I'll be talking about writing a book, why you should do it, what it should be about, and how to do it. So I suspect a lot of you have thought about writing a book. So why should you do this? I know I've written a book. Some of you may have a copy of it, and I thought it would be a worthwhile subject for us to discuss. So thank you very much for joining me today. Wishing you a wonderful rest of the day, and signing off. Marie, darling, you are my